joining me this afternoon. We have a very interesting topic in one of our Adulting 101 sessions on home buying, home ownership, whether it's possible, feasible, desirable to own a home, to do it while you're in college, whether you can afford it, whether you cannot afford it. All of those good questions and many more will be answered today. Our guest speaker today is Heather Bowman, who is with the National Homebuyer Education Program with the Idaho Housing and Finance Administration Program. And Heather is a Boise State alumna with a master's degree in public administration, which is very cool, and also has background in sociology and that sort of, so she's a people person and comes from a realtor background, so she knows what she's talking about. And we are happy to have her here.
Thank you.
Thank you, Heather.
Thanks. Hi. Glad you all can make it. I'm happy to be here. Just kind of wanted to thank Justin for bringing me in. Today, just kind of wanted to go through some different things about home buying. We'll talk about facts versus myths about buying a home, kind of give you guys some tips and tricks on when you're ready to set forth on purchasing, what you really should look out for, how student loan debt will influence purchasing and how you can plan ahead. Also provide kind of a high-level overview of the home buying process and the importance of becoming an educated buyer, and then additional resources that are available to assist. What many people don't realize is in the home buying process that there are so many resources out there to help. So many organizations, nonprofits that are available that will assist for free and can offer guidance and counseling on the home buying process, as well as giving tips and tricks, and there's education programs that are available. We have a homebuyer education program that I'm going to talk about a little bit further on in the slides, where we go through home buying from start to finish. So what I'm going to cover today is just a really high-level overview. It's hard to get through everything in an hour when it comes to home buying because there's a lot to it. So we'll just move on a little bit. Why did you think people want to buy homes? Why are you guys interested? I guess show of hands. Who in here wants to buy a home? Either now, okay, in the near future, like say within the next 5 years, okay, and then anybody long-term planning 10 years out? Okay, good, all right, good. Some of the main reasons for wanting to purchase. What do you guys think are some of the main reasons people want to purchase? Why do you guys want to purchase? Throw it out there.
I guess like the freedom that comes with owning your own home as opposed to like an apartment or something.
Okay, good. So the first slide represents just that, having your own space, being able to have a pet. That's a big one, why a lot of people want to purchase for their first homes. Customization. When you're renting, it's really hard to be able to go in and put the paint color on the wall that you want. It's also hard to make any additional changes that you want without getting permission ahead of time. So that's one of the things that owning your own home can really truly afford, is you can go in and you can make it exactly how you want to make it. People look at home ownership as basically that start in when they want to start a family. So it gives them that stability. So every time your lease runs out, you don't have to move. You don't have to deal with the thought of, as long as you get a fixed rate mortgage, you don't have to worry about your payments going up every time your lease renews, or you get notice that you've got a $100 increase coming up next month. Also pets again. A yard. Everybody likes to have additional space. So many times when we're renting in small apartments, or we're sharing space with others, and you can't do the things that you necessarily want to do. Let me give you some tips on why home ownership in the long run is really a true financial benefit. Don't get me wrong, there's a lot that goes into owning a home, and it can be very expensive and at times it can be much more expensive than renting. But in the long run, homeownership truly is one of those things that creates wealth. And the Federal Reserve does a consumer financial confidence survey every few years, and the most recent one that was done in 2017 came back and said that a homeowner's net worth is 44 times greater than that of a renter's. 44 times. Essentially, with the parameters they looked at, they said that a net worth of renter A was $5,200. So that was what they had. Versus a homeowner's, with the same parameters, had a net worth of roughly $231,000. So, and it's also one of those things long-term that we look at for sustainability. So the first home that you buy, it's going to be a starter home. It's not going to be perfect. It's not going to probably be in the location that's ideal. It's not going to have all the bedrooms and all the bells and whistles that you want. But it's just that. It's a starter home. It gets your foot in the door, and then you can work your way up. So you live there for a few years, and then you can upgrade as your financial status increases, and as you are able to save more, you can continue on moving along. Same thing goes for long-term, way down the road, when you guys are thinking about retirement. Most people that are getting to the point that are retiring, those that have the best situations are those that have paid off their mortgage. And the only thing they have to worry about for home ownership costs is their taxes and insurance on a yearly basis, and then routine upkeep on their properties. So that's really something to think long-term about. Get into something, it doesn't mean you have to stay in the same property for your entire life. It just means that it's something to work towards, and it's a good goal to have in the future. Okay, let me give you an example of how the difference in savings can accrue so quickly in renting or in having a mortgage and owning a home versus renting. So as you'll see in the blue up here, we've got, if you had a mortgage for a $190,000 mortgage, you'd roughly be paying about $1,020, depending upon interest rates. We'll just say you're paying $1,020 a month towards your mortgage. Average rent, we're going to talk about average rent in the area. It's much higher than $1,000 around Boise area, but let's just say you're paying $1,000 a month in rent. After 5 years, your total expenditures towards your mortgage would have been $61,200. Towards rent, you would have paid $60,000 in 5 years. Your overall equity that you would have gained in your home at that point, that's just paying down your mortgage and having that small percent every month towards your principal, would be $19,431 versus having zero in your pocket after paying out $1,000 a month in rent for 5 years. So that $19,000 doesn't even include in the chances that your home will have already appreciated with just the appreciation in the housing market in general. So there's a good chance that this $19,000 figure probably would be more like 25, 30, potentially even 40,000, depending upon the market and how things are running. Now, of course, we always run into that risk where it could go backwards and you could lose money, and so that's why we always advise, and most people always advise, when you're looking to get into home ownership, plan on it being at least a 5-year commitment. Don't jump into it if you're thinking that you're going to move in 6 months, or if you've got job changes that are coming up, or you've got some really large expense. Maybe you've got some sort of a health thing coming up that you've got to spend a big chunk of change on. So 5-year time frame is usually pretty good. The recession back in 2007, 2008 and then moving along, that was kind of an anomaly. The housing market always has ups and downs. It's very cyclical. You'll have it appreciate a ton, and then it'll ease off and come back down. I'm not an economist, but everything that I've read, everything that I see says that the chances of us really bottoming out like it did years ago is, it would take a lot to get to that point again. So really, real estate kind of is one of those things where if you do it right, you plan for it, you're very conservative about it, it can be a good investment, but you just have to be careful. Nothing's for sure. So, and then the bottom section is also, that's a similar scenario where you're looking at a $1,500 mortgage essentially versus $1,500 in rent, and you'll end up saving about $28,000 over the course of 5 years. Okay. So let's talk about rent. Rent in Boise, Treasure Valley, really expensive right now. I'm sure you guys are all feeling this. Right now, the average rental prices in Boise are about $13.95 a month, and I think that, Sarah, was that for a 1-bedroom or 2-bedroom, or is that just general?
It's just general.
General average. So, down here at the bottom where it has estimated mortgage payment, what we've kind of done with this is you can see the difference. So if you were to go out and you were to buy a house right now, and you were to put 3.5% down at an interest rate of 3.8%, for if you were paying property taxes each year of $2,400 a month, or a year, excuse me, you have, because you're putting less than 20% down, you'd be required to pay private mortgage insurance, which is at 0.5%. And then home insurance each year. Essentially, your total mortgage payment on a monthly basis for a $250,000 home would be $1,500. That's the same amount that the average rental price in Meridian is right now. So, just some food for thought there. Any questions on that so far? Yeah.
What is equity?
So equity is going to be the amount of money that you have essentially made. So let me think if there's an easy way to explain this. So I buy a house for $200,000, and the house appreciates by $10,000. So I buy it for $200,000. I go to sell it in a year for $210,000. And that $10,000 is the equity. So you've made $10,000 on that amount. Does that?
It's not even the housing market rising, it's just from having the house for 1 year.
So equity would just be the amount of money that you are in the plus on. So it could be any. Sir, do you have a better way to explain this?
It could be both it appreciating, and it could also be the amount that you pay towards your principal. So your equity could include, if you made a really big down payment, on the home, it includes like an appreciating. It would, and equity it's there, it's a number, but until you sell the house, it's not tangible
realized.
funds.
Yeah.
So it's always nice when you're, a homeowner, kind of keep track of how much equity you have, especially when the market goes up, because maybe you do decide it's a good time to sell, so you can't get into that next house. But until you actually sell it, it's not money that you have. But it is, if there was an emergency and you needed to sell the house, it's nice to know that you walked away with $20,000 additional dollars that you didn't have to begin when you purchased it. Okay. Does that kind of make sense? Yeah.
It's complicated, and it's like it's a theoretical, like it's a number that's not, you don't have it in your hands, so it's kind of hard.
I always thought it was the market, like from the market, when you sell it, the market's good, that's how much the net you get. I've always thought that.
So it essentially is going to be your net profit at the end. So when you walk away, so if you invested $200,000 into it, and then you ended up selling it for $210,000, then that $10,000 is going to be your takeaway, the equity, the profit.
If you take out a second mortgage on a home, does that basically negate your equity?
It can. Yes, it can. So What second mortgages, well, it depends. If it's a home equity line of credit or taking out a second mortgage, depending upon how it's framed, that's essentially what's happening, is you are borrowing against the equity in your home. So say you have $50,000 in equity, and the bank comes back or the lender comes back and says, hey, I will give you a second loan or a home equity line of credit for $25,000. You are borrowing that money before you're getting it in your hands. So you're taking away from what you could have earned if you would have sold the house right then. Does that make sense? So that can be kind of tricky and that can be kind of scary. That's where a lot of people got into trouble during the housing crash, because in years 2005, 6, and 7, when the market was just skyrocketing, they were getting notices from their servicer and from their lenders left and right. You are pre-approved for a $30,000 home equity line of credit. You can open this up at any time. You've got all of this added value in your house, take it. So people were taking it, and in some cases it can be a really good thing. If you've lived in the home for a long time and you need to do some updates, maybe you need to pay for a new roof, maybe you need a new furnace, tapping into that equity that you have can be a really smart thing. But if you're not putting it back into the house and then prices drop down, then you'll be out what you originally borrowed, and then you'll be out the additional that you borrowed. So you have to be careful. So key takeaways that I really hope that you guys will walk away with today is number one, educate yourself. This is not something, and you're making, the first step that you made is by being here today, so thank you, that's awesome. Make sure that you are really prepared before you jump into this, and we're going to talk a little bit more about how you prepare coming up. Don't jump into it lightly. Like I said, if it's not something that you truly can commit to for a few years, don't do it. You know, if you're like, well, it'd be really nice to have my own place so I can get a dog and I can move out of my parents' house, or I can not have 3 roommates anymore. But, you know, I really think I want to move to the East Coast here in 2 years. Really think that over. You know, there's always options to rent your property out and do things like that, but it really kind of ties you down a bit. You're responsible for that. And then if you do rent it out and you move away, you've got to have somebody to take care of things. So just keep that in mind. What I also want to get at is with proper planning, saving, and education, homeownership is not out of reach. I know with prices these days where every week there's a new article on the Statesman or on KTVB about how the housing prices are just the highest that we've ever seen. They are, but there's still affordability out there, and there's still programs that are available to help first-time home buyers get into homes. So even though the prices are really high, interest rates are phenomenal right now. The average interest rate right now is about 3.8% for a 30-year fixed mortgage. That's some of the lowest that we've ever seen. I think at one point down in like 2011, I think it dropped as low as like 2.2%, but 3.8% is really great. And I'll give you some scenarios about how it makes such a huge difference here in a minute. And then if you look back on when your parents or your grandparents purchased, when your grandparents purchased homes, they were paying 12, 14, 17% interest on properties. So, big difference. So right now I kind of want to just talk a little bit about myth versus truths or facts in home buying. So many first-time home buyers have kind of this idea in their minds about what home buying is all about and how do I get into a home. And so I just kind of wanted to go through some of these and clear up some of the fact versus fiction. So myth, what do you guys think? Do you need 20% down to buy a home today? I'm seeing a few heads shake. Absolutely not. You can get in on an FHA loan for as low as 3.5%. There are other loan programs out there that you can get in for anywhere between 3 and 6%. The kicker is if you put less than 20% down, and I think this is where the myth comes in, is less than 20% down equals private mortgage insurance. That means you're going to pay an additional amount every month. Basically, the lender is insuring with you paying that additional every month that you're not going to default on the loan because you have less skin in the game, so to speak. But there are tons of loan programs out there where you can get in for 3.5% down, and then on top of it, there are programs for first-time home buyers and others that give down payment and closing cost assistance. So we see people that are getting into homes now, and maybe they're only putting 0.5% down, getting into a home for $1,000 essentially with that additional assistance. So it is possible. There's help that's available, and some of them it's really good deals. Some people think, well, gosh, that can't be true. There's got to be a catch to it. Why would somebody want to give me that? You know, if you're getting the down payment, closing cost assistance, there are some grants that are available. Some of it is in the form of forgivable grants where you'll pay a monthly payment, or you'll have it for a time period where it would be due and payable if you sold the home, but if you keep it for a certain amount of time, then it's just forgiven. So there are some cool things available. So fact, loans are available that require as little as 3.5% down, and there's programs for down payment closing cost. Myth, you can't buy if you have bad credit or no credit. What do you guys think? Can you buy with bad credit or no credit? Anybody? Okay. Let's start with this. Does everybody know about credit scores and you got to keep your eye on credit scores? I think you had last week's speaker.
Todd Christensen was here last week.
Todd was here, yeah. So with credit, really a good solid credit score is going to be in the 700s. But many loans are available now that will go all the way down to, I think FHA will approve all the way down to 580. But there's extenuating circumstances with that. You're looking at about 620 to 640 usually is the minimum that you need to be. What I wanted to focus on here though is a lot of people that are coming out of college that haven't had credit cards before or haven't had any situation where they would have a credit report created for them. It's called they don't have credit, essentially is what it means, no credit. And a lot of lenders out there do look at non-traditional forms of credit. And so what that means is if you don't have a credit score that's reported under the big credit bureaus, then they will want to get your payment history for maybe your telephone bill and for your rent. And they can create a non-traditional credit report using your historical payment history. And so most lenders will allow for that, and they will work with you on that. Okay. Myth, getting pre-qualified for a loan is the same thing as getting pre-approved. What do you guys think? Is it the same thing? No, it is not. Pre-qualification means a rough estimate, and honestly still, I get these two confused all the time. Basically, when you call up a lender and you want to find out how much you can get approved for or how much you can get a loan for, they're going to run the numbers that they give you in their computer database, and they're going to give you a rough estimate. Basically what it means on pre-qualification is they say, yes, I will lend you $250,000 based on the information that you're telling me on the phone. What that means is they have not done their homework on it. They have not actually ran all of the information. They haven't looked at your income statements. They haven't done their homework on it to truly give you a approval on that amount. This is just a rough estimate that they say, yeah, based on what you're saying, you'd be approved for this much. Then pre-approval is when you actually get to the point where you're like, okay, I'm serious about this. I'm gonna buy a house this week. I'm gonna sign on the papers or move forward with something on this week. I want to know how much I'm pre-approved for. Give me a letter that says I'm pre-approved for X amount of dollars so I can go out and make an offer on a home. So that's what the difference is. Myth: if the bank approves the mortgage, you can afford it. What do you guys think? No, good. I'm so happy you guys are answering that right. Okay, here's the thing. Lenders look at gross income. Can anybody tell me what gross income is? Exactly. So maybe you make $40,000 before taxes. After taxes, maybe your actual checks, you only take home $30,000 of that $40,000. So it's very different. Typically, most lenders are looking at a housing ratio of 31%. So what that means is that they say that you all can afford to pay 31% of your gross income towards a mortgage or towards rent. That may be very different than what you're actually paying currently for rent than what you could be approved for. So it's just something to keep in mind that it could be very different, and you in no way want to go into a lender and say, hey, what's the most amount of loan I can get through you? We're going to talk about a little bit more about how you need to go in with a number in mind that you want to pay on a monthly basis and work backwards. Myth: shopping for a loan will hurt your credit. This goes for shopping for a car as well. Getting pre-qualified, so that initial, when you talk to the lender and you say, hey, I just need a rough estimate, how much based on my income, based on what I think my credit score is, how much will you give me? It's a soft hit on your credit. It's not gonna damage your credit. Now, the actual pre-approval, where they do the deep dive into everything, that is going to be a hard hit on your credit. Here's the thing though, when you're shopping for mortgages or you're shopping for cars, the credit rating industry can see that. And so if you have that initial hit and you have 5 more over the course of, like, say 2 weeks to 4 weeks, nobody really knows what that magic time frame is. But essentially, if you're doing it all at once in a short period of time, they're only going to count it for decreasing your credit rating as one hit. And so that's a protection that they have for you guys, so that you can shop around and make sure that you're getting the best rates and the best mortgage. Myth: a down payment is the only upfront cost of buying a home. Nope, you're right. There are many other fees that are involved in purchasing, such as a home inspection, closing costs. Essentially, you've got 3 to 6% of your purchase price. You're going to be paying closing costs. A lot of times, though, you can get closing costs as part of the offer that you make to buy a home, where the seller will actually pay your closing costs. Yes?
What are closing costs?
What are closing costs? Closing costs essentially cover the price of getting a mortgage and all of the fees that get into paying for a mortgage, plus everything else. So you've got a ton of people that are doing work for you while you're trying to purchase a home. Prime example, they're going to run title and escrow is going to do their thing, where the title people are going to run a title search, on the property that you're gonna get. And they are going to basically give you this report, which will detail anybody who may have prior rights to that property or a lien against the property. It's basically a protection. They charge a fee. You're going to pay for a portion of the property taxes for the remainder of the year. You pay that up front. That's part of the closing costs. When you're meeting with the lender and you're getting, you go and you say, okay, I've decided on you, lender. I want to get a loan through you. For them to give you the loan and process it, they're going to charge you processing fees. They're going to charge you document fees. They're going to charge you an origination fee. So it's just, closing costs are all of those items all wrapped into one that you pay on the day. And they call them closing costs because essentially you're going to pay for them on the day that you go in to sign the papers. You're going to bring in a cashier's check where you're going to have your funds already wire transferred over, and it's going to cover all of these items all at once. Your down payment, your origination fee on the mortgage, any other fees, your appraisal fee if you haven't already paid for that, things like that. All right. Is homeownership out of reach? We kind of talked about that. I don't think so. I think it's very doable, and it just takes some time and some savings, and you've got to be patient. So probably the biggest thing that many people are thinking about these days is student loan debt. How is your student loan debt going to affect your chances of being able to get into a mortgage, buy a home in the near future? And, you know, the simplest form is, yeah, possibly it's going to impact it. Here are the ways that it's most likely going to impact it. It can make it difficult to save for a down payment, so you're having to pay, say, $250 a month on student loans right when you get out of college. You could be putting that money away for a down payment, so there you go. Can make it more difficult to pay your mortgage. Once you get into a home, if you're having to pay both at the same time, that can be a little bit more challenging. It's going to increase your debt to income ratio, which I'm going to talk about, and I'll explain what that means more here in a minute. And any missed payments could potentially lower your credit score, and I'm really going to hit on that one in a minute as well. So what will lenders count towards my debt to income ratio? I'm going to come back to this portion because I think I need to explain what debt to income is first before we get back into this. One of the things that I don't know, I'm by no means an expert on this portion of it, but one of the things that everybody probably should think about is consolidation of student loans when you get out. That's one way that you can kind of possibly work things out and get a more affordable rate, so to speak. Is consolidation right for you? It could potentially lower your interest rate, reduces your monthly payments on your loans, but you need to know the terms, pay as agreed, pay on time. And then the other thing too is something to think about is there's all these agencies that will be reaching out after you graduate that are going to say, hey, I can consolidate your debt and all of your student loans. I'm only going to charge you $15.99 to do so. There are places where you can go that do not charge a fee. Know that there are resources available that are free. You do not have to pay somebody to get advice and help you fill out the paperwork on loan consolidation. So just keep that in mind. And then think about the pros and the cons. Should you consolidate your loans? It can simplify your loan repayment. You only have one payment to make a month instead of making to 4 or 5 different places. Lower payment over the long term, essentially, but it can extend the life of the loan out for consolidation, so you could be looking at upwards of 30 years to pay off your student loans. But The positive thing is it could move it from, if you have an adjustable rate, can move it to a fixed rate, so your payments can't go up. Cons, longer term, increased interest, and you could end up paying interest on an outstanding interest. So. And then another, this is more of a myth. A lot of people have said, well, when I go to buy a home, my student loans are in deferment, so it doesn't matter. I'm good to go. I don't have to include that, what I will be paying towards my student loans for my mortgage. And that's not the case. They've made a new law came out a couple years ago that basically said that all lenders have to look at your overall student debt before they approve you for a mortgage, and it has to be included in your debt to income ratio. So essentially what they'll do is they'll take either the actual payment that you have each month, or they'll base it off of the total amount, and then they have a formula that they use. So if there's anything that I can give advice on with regards to student loans and buying in the near future, is the number one thing is to make sure that you stay current on your student loans. This is one of those payments that if you fall behind on, it is going to really, really mess up your credit score. And then not only will you be having to figure out how to repay your student loan debt, but then you're also going to be rebuilding your credit at the same time. So just keep that in mind, that's really, really important. Even if you have to figure out a forbearance plan or a repayment plan with your student loan lender, come up with some sort of a plan versus just not paying. Okay, so when you go in to talk to a lender to find out if you can purchase a home, they're going to throw around a bunch of real estate jargon. And this is another reason why it's really important to educate yourself beforehand, go through some sort of an educational course on home buying, do research online, go to a housing counseling agency for assistance. There's just so much real estate jargon that it's important to get well versed in it. So we've been talking about debt to income. And what that is that's a ratio that lenders look at to approve you. And they're essentially going to say they're going to take all of your monthly debt obligations, and then they are going to divide it by your gross monthly income. And that is going to be a percentage. And that percentage is your debt to income. So many of the loans, so we've got FHA, these are different types of loans that are available out there. FHA, conventional, USDA, VA, they all have a different percentage rate on debt to income that they will approve. So basically what they're saying is they say, we can't give you a loan for any more than this because you'll throw off on ratios. Housing ratio is that 31% number that we talked about a little bit before. So that's going to be your total housing cost divided by your gross monthly income. So you're going to hear those numbers quite a bit. Any questions on that? Yes.
On your monthly debt obligations, we're talking about loans and that type of thing,
Yes.
plus your monthly expenses?
Not your expenses.
Not your expenses.
These are going to be items that are typically reported on your credit report. So it's going to be credit card payments. So if you have a month, say you have $100 a month that you have to pay towards your credit card, that is going to be included in it. Any other loans that you may have, a car loan, if you have a car loan, that will be included in it, and student loans. And then they will add in however much your mortgage, they're going to approve you for a mortgage into that ratio as well. So when you go in and you say, I want to be approved for a $250,000 mortgage, they're going to figure out what that monthly rate would be, and then they're going to add it to all of the other debt that you have. So your credit card payment, your student loan payment, and maybe your car payment. They're going to add all four of those numbers together, divide it by your gross monthly income, and it's gonna give you this ratio. And then they'll say, okay, for this particular loan, you have to have a ratio below 45%, 43%, 41%, just whatever the terms of that particular program are. Okay. So these 45, 43, 41, those are pretty standard, so just keep that in mind. Any other questions on that? Okay. Set goals to accomplish home ownership. So make sure, here's something that you guys can start on now. Make sure that your student loans are being reported on your credit reports accurately now. They should be, even if you're not, as soon as you're at the point where you're repaying them, make sure that they are reporting properly. Utilize student loan repayment estimators. So there's all kinds of calculators online that can give you scenarios as to what would happen if you consolidate and how you can pay all of that off and how long it's going to take. Review any repayment plans if you need them, if you're eligible. Create and follow a budget. That's the big thing. To get to home ownership, to get to saving, you've got to have a budget. I know it's so hard. I hate doing a budget. It's one of my least favorite things, but it's got to be done. Work to improve your credit, or if you don't have any credit, that's something that you can work on. Open up, talk to your current bank, look into getting some sort of a secured credit card if you don't trust yourself to open up a real credit card yet. Secured credit card basically means you take in $100 or $200 to your bank and they give you a credit card, but you can only spend up to that amount that you've secured it for. Be careful with that though. A lot of places charge fees on that, so make sure you check before you do that. You can consider consolidating debt, manage your debt to income, and pay down outstanding debt to help repair. This one, I think in a matter for time, I'm gonna bypass some of this a little bit on the housing ratios. We can come back to it if we have time. But really, I just wanted to kind of show you this one particularly. So these are the average rental prices. Oh, we already, did we talk about this one already? Okay. So let's go into the overall steps involved in purchasing, because I think this is really important as you guys get started in the home buying process. First and foremost, you're going to determine if home ownership is going to be right for you. We talked about this a little bit, that it's really important to identify what your 5-year goals are before you jump into buying a home. If you're going to up and leave, if you want the freedom to up and leave, or you're planning on moving, you're planning on changing jobs or careers anytime soon, really think about that before you jump into it. Check your finances, have a budget. Before you go talk to your lender, make sure you have that number in mind. Know how much you think you can reasonably pay on a monthly basis for housing. Because maybe you're sharing an apartment now, or maybe you're sharing a house now, and you'll have a $350 payment. Maybe you'll be making X amount when you graduate and you go out, but if you just go in and say, hey, I make so much money, the lender's going to come back and they're going to qualify you for the most amount that you can get for, and they're just giving you the options. They're going to say, okay, based on how much income you have, this is how much you can qualify for. You just really need to keep that in mind, that what you can qualify for may be very different than that number that you're comfortable paying every month. Check your credit score. That's the other thing. And I know you guys had the Todd here last week talking about credit, so you should all be aware. The credit score that you're going to get from the lender is going to be different than what you're going to get from either your credit card company or any of those online, where they say check your credit for free, or check your credit score for free. Those use a different model, so they can range quite a bit. They're usually within a fair range, but they are gonna be a little bit different. And then develop your housing budget. And what I mean by housing budget is, not only are you thinking the amount that you're gonna pay on a monthly budget or basis, but you also kind of need to keep in mind that you also need to be having a slush fund within your budget to save for incidentals. So many times, have you guys heard of the term house poor? So what house poor means is that you bought a great house, but you bought at the very top end of your budget. All of your free, not your free money, but all of your accessible money that you have to spend every month is going towards your house payment and towards maintenance towards your home, and then you don't have any left over to do fun things like go out to dinner and, I don't know, go bowling or whatever. So that's something to keep in mind. And also you have to keep in mind too that when you purchase, you're responsible for everything that goes on with your home. So if, prime example, with my first home, when I first got into my home, within a year, my water heater went out. And I mean, it literally went out. It like exploded and there was water all over my garage. I had, 100 gallons or however many the water heater holds all over my garage floor. And I went out and I was like, well, shoot, what am I gonna do now? And that was an $800 expense because it had to be fixed. And your insurance doesn't cover that. There are home warranties that you can look into. That's a little bit later down, but your insurance won't pay for that. You can't call up a landlord and say, hey, my water heater's broken, come fix it. It's your responsibility when you're a homeowner. So that's just something to keep in mind, that you have to be putting money aside every month in kind of a slush fund, so that when things like that happen, little hiccups like that happen, because they happen a lot. I mean, there's always something that's gonna happen, that you've got the resources available to pay for it. Because a lot of times what potentially could happen is if you're on your very high end of your budget and you don't have any additional resources, and you have something like this happen, then you get down to it and you're like, well, I don't know what to do. I can buy a new water heater, or I can pay my mortgage this month. So just something to keep in mind. Second, many people think that they should go out and start looking for a house on the online websites, or call a realtor and go shopping for a house first. Talk to lenders first. Know how much you can spend before you start looking for a house. You absolutely want to do this, especially in this very competitive housing market. If you go out and you see a house that you're absolutely falling in love with and you want it and you want to make an offer, you need to make sure that you have talked to a lender and you have those resources taken care of first. And shop around. Talk to multiple lenders. They all have competing products. That means lender A, you may get an interest rate of 3.8%. Lender B, maybe you'll get an interest rate of 3.2%. But then why we say get educated on this process is there's a lot more that goes into it. There's fees and so forth. So you want to make sure that you know how to shop around and you can get the best deal. Know how much you want to pay towards housing each month, talk to lenders, and then get pre-qualified for a loan amount. Third, research and choose your real estate agent or your realtor wisely. This is going to be your person that is going to be your advocate throughout the home buying process. You want somebody you like. You want somebody you trust. If you don't like them or you don't trust them, there's lots of people around. So this is your home buying team. You are essentially hiring them to come and work for you. Make sure you find somebody that you're comfortable with. And then you can start shopping. Once you get all the financial prerequisites done. And that's the other thing. A lot of people will go into it, they'll find their realtor, they'll find their house, and then they'll turn to the realtor and they'll say, hey, who do I use for a lender? which is a good option to talk to your realtor about it because the realtors know lots of lenders in town. But you want to make sure that you've done your homework and you find a lender who you feel comfortable with. There's lots of different types of lenders that are out there. There's mortgage brokers, there's the big banks, say maybe whomever you have your checking account with or your savings account with. There's credit unions. There's all kinds of different resources. You'll go on to determine title and escrow officers. You'll review your title report, we kind of touched on. You'll shop for your homeowner's insurance. And fourth, you're going to prepare for closing. You're going to do a final walkthrough of the property, verify that everything that you've asked them to fix has been fixed. You're going to review all the paperwork. So at first, when you first get pre-approved for a loan, the lender's going to send you a loan estimate within 3 days. You want to make sure that everything on that loan estimate is what it should be. With the housing crisis came a new rule called Dodd-Frank, or a new law called Dodd-Frank. They have streamlined what the paperwork looks like that consumers get, and it's truly in the consumer's favor. It's super simple to understand. It gives you all of the terms laid out in boxes so that you can easily understand it. It'll say if there's a prepayment penalty. It'll say what the loan term is. It really simplified it and made it easy. So essentially what you're going to do at this point is you're going to compare the initial loan estimate with the final closing disclosure that's going to have all the final and make sure that everything matches up. And if it doesn't, ask questions. Again, your home buying team is there for you. You should ask as many questions as possible, and then you'll close on your home. Here's the kicker. Really good, really important piece of advice. Absolutely do not sign any documents until you have read them and you understand them. We always teach in our homebuyer education classes that prior to closing, have your escrow officer who is conducting the closing send you a copy of all the documents ahead of time so you can read through everything in the comfort of your own home. You have time. You don't have 5 people sitting around a table waiting for you to read something and sign it. So don't sign anything unless you're completely comfortable. Become an educated home buyer. Like I mentioned before, there's lots of resources out there. My organization, I work for Idaho Housing and Finance Association. We are the state housing and finance agency for the state. There's agencies similar to ours in each state. We do a lot of work with affordable housing. Our whole mission is to promote affordable housing across the state. And one of the things that we have developed with that is a homebuyer education program called Finally Home. It goes through the home buying process from start to finish. The overall class is about 6 hours, so this I crammed everything I could in an hour here. But really the course itself is about 6 hours. There's a lot of good resources. It really goes into more detail about loans and how to get qualified and how to find a lender, how to find a realtor, what the difference between APR and interest rates are, so you know how you can see the difference in fees from the different lenders. So this is always available. It's an option if anybody's interested. It's at finallyhomecourse.com. So you may be thinking, okay, I just sat through 45 minutes to an hour of Home Buying 101. What else could I need to know? Well, we didn't even touch on all the different loan types that are out there. There's government loans, there are conventional loans, there's adjustable rate mortgages where your interest rate could fluctuate depending upon the market. It will be fixed for a short period of time, and then after so many years it could go up and down depending upon the way that rates are. Then there's the fixed rate mortgage. So there's all kinds of different loans that are available out there that you need to learn about. The closing process, I just barely touched on the closing process, but there's a lot more that goes into it with your escrow agent, title searches. That's really important. Prime example is how you can use your home. You need to know, like if you're going in and you're buying in a subdivision, what the HOA fees are, what are the conditions and covenants within that subdivision are. Can you park maybe you want to go buy an RV, can you park your RV in the driveway? A lot of subdivisions have rules against that. Sometimes they have rules against even parking additional cars in your driveway. So there's a lot of things that the title process, when they come up with the report, you'll get a copy of all of the rules and regulations on that subdivision, and then you'll also find out if there's any variances. Maybe it looks like your lot line is here and the fence is there, but through the title search they'll say, oh, actually, the lot line is messed up and you own 5 feet over or 5 feet less. So there's a lot of protections that go into it that you need to be aware of. And then what to expect in a home inspection. Here's something that I didn't talk about that's really important. Some people, when they're buying their first home, they think, I'm buying a brand new home. Do I need a home inspection? Answer is always yes. Even if you're getting a brand new build, you still want to get a home inspection. And when you go through an education program, you'll learn more about what the home inspection entails and things that you can look at yourself, and the importance of that. You'll also learn about predatory lending practices. We haven't really talked about it, but this is really important. If you go out and you try and get a loan and the lender says, you know what, I'm sorry, this just isn't going to work. Maybe you go to somebody else and they say, oh sure, even though lender A down the street wouldn't give you a loan, I'll give you a loan, but I'm going to charge you 10% interest rate. This happens a lot. People get panicked, they think that they're not going to be able to purchase, and so they go to potentially predatory lenders that will say, yes, I'll give you a loan, but I'm going to charge you a significant more for that. So keep that in mind. There's options available, and if you're not quite there, there's resources available to help you prepare, get that budget intact, get your credit score up, that really can help you, that can keep you out of trouble, because nobody wants to see somebody going in and getting a loan that has just ridiculous terms because they feel like they're forced into it, that there are no other options. Let's see, we're almost out of time, so buzz through this a little bit. Things not to do before buying a home. We kind of talked about this a little bit, but these are important ones. So you're really getting serious about purchasing, don't move a lot of money around. If you have your checking accounts and your savings accounts, don't move things around before you go talk to the lender. They want to make sure that they're going to look at all of your finances. So they're going to ask you for your bank statements for several months prior to look at things. And if they see lots of money going in and lots of money going out, they're going to question it. They're going to want to know what's going on. I say changing jobs, but this is more of changing careers. It's okay if you change your job if it's in the same industry, but lenders want to see stability. So one of the biggest things that we say could foul you up would be is if you have a wage earning job and then all of a sudden you decide, you know what, I want to go be self-employed. I'm going to go become a real estate agent, or I'm going to go become a lender myself. And you don't have that W-2 form where you're getting a standard wage and you're going self-employed. So you're going completely different careers. If you do go self-employed, they want to see 2 years of profit and loss statements to prove that you're making enough to maintain the mortgage. So keep that in mind. And then putting any new purchases on credit. So even during the home buying process, so you put an offer in, it's accepted, you're in that 30, 45-day wait period while all of the real estate people are doing their thing, getting it all ready for you to close and buy. Don't go out and put a bunch of furniture on your credit card, because that can throw off your debt to income ratios and your housing ratios. And a lot of times lenders nowadays are pulling your credit again right before you close. So just keep that in mind. And upfront costs to think about, you've got down payment, closing costs, escrow account, cash reserves, we already talked about most of that. Agencies that can help. They're HUD-approved housing counseling agencies, and basically what they are, they're free services that will provide housing counseling for all the different types of housing. So even if you're in a situation where you're having problems with renting, maybe you're having problems with a landlord, or you're having problems finding affordable rentals, we do have housing counselors that are available that can assist on rental counseling. And then we have pre-purchase counselors. So pre-purchase counselors, we always encourage a full homebuyer education class first, but then if you need some additional assistance with budget and planning, the housing counselors will sit down with you free of charge, go through all your stuff and help you get on track. Then post-purchase, so after you get into your home and say a couple years down the road, you've got, maybe you have loss of income for some reason, or you've got something that comes up and you're having problems making your mortgage payment, there's housing counselors that can assist on that end too, to try and help get you back on track and help act as an intermediary between you and your, what they call servicer, who you'll be making your payments to. So the organization that I work for, we're a HUD-approved housing counseling agency, and then NeighborWorks Boise here in town has counselors as well, and then NeighborWorks Pocatello in the eastern side of the state. And then these are kind of silly. A colleague of mine always does cat videos in their presentations, so. And with that, don't get caught off guard, be an informed homeowner. So, any questions?
What's your opinion on going to an architect and designing your home?
That sounds fantastic. You certainly can do that, but there's a lot that goes into, if you're a first-time home buyer and you're going about that process, there's a lot more that goes into it, because then you have to consider, you've got to get a construction loan and how that's going to parlay into a permanent loan once your property is built, finding the builder, finding the plot of land. Then there's all kinds of additional ratios that they look at for construction loans, where your loan price can only be a certain percentage of the value of what the home will be. So it's more in depth. It's definitely doable, but it's just more in depth.
Being educated, is there opportunities to save money going that route instead of just buying a new home, or is it generally more cheap to build?
Might have more equity initially.
Yeah, exactly. There might be more equity initially, but it really just depends. I mean, if you own the property already and you're going to build a house on it, then that's going to take away the amount that you potentially would be paying for that piece of land. So there could be savings that way, but I think all in all, I as a first-time home buyer, it would be a challenge, I think. It definitely doable if you do your homework and do your research and make sure that you really plan it out. I think it's doable, but it's one of those things where there's a lot that goes into it. And it's very different than just calling up lender and saying, hey, I need a 30-year fixed rate loan. I'm buying at such and such an address, and they can pull up the property information and they can say, oh yeah, no problem. But it's possible. Anybody else?
Any other questions?
I know you mentioned this a little bit already, but more explicitly, could you say what kinds of payments factor into your credit and which don't?
Okay, so credit card payments are reported on your credit score. Any of your student loan payments are going to be reported on your credit. Car payments, pretty much anything that's reported. Sarah, can you
So if you go to More Furniture, RC Willey, or those type of, where you're getting like an in-store credit card, those usually report things like utilities aren't going to be, reporting on your credit, that's why they factor it into like the non-traditional.
Yeah.
But anytime where you're going to someone and they're essentially lending you money and then you're making a payment to them, it's gonna be reported.
What about unsecured debt, like medical bills or those kinds of things that you need to make payments on?
Yes, they do not report those unless you're in default on those. So if you have medical debt and you have a prearranged payment plan, I believe, and correct me if I'm wrong, Sarah, but the only time that those will start showing up on your credit report is if they're in collections.
The only time I've seen them pull on people's credit when I'm doing appointments is when they're in collection.
And I'm sorry, I don't know if I introduced her. This is Sarah Rainey up here. Sarah is one of our housing counselors at Idaho Housing and Finance Association. So she does pre-purchase and reverse mortgage and
Foreclosure,
for-
post-purchase, I do.
the whole gamut. So she's one of my colleagues at IHFA, so she's here today. So yeah.
What about buying multiple homes and renting them out? Is that what's your opinion?
My opinion. I wouldn't take too much stock in my opinion. Yeah. If you can afford to do it, rental properties are a great form of income stream. You just have to remember too that you have to be responsible, and if you have a renter that moves out or damages the place, then you're on the hook for one, paying the mortgage until you get somebody else in there to be getting that income stream back up, and then also any repairs that need to be made. But I know a lot of people that they use that. In fact, I've got a colleague right now that is what she's banking on. They have they have several rental properties in town, and she's going to use that as her retirement. So it can be a good investment for sure.
Maybe not your first house. Maybe turn your first house into a rental when you're ready to buy your second house.
Exactly. That's a good way to look
Always
at
make sure
it.
you can make the payment without anyone in it.
Yep.
Thank you.
So we've run just a little bit longer than we normally do, so I know that Heather will stick around for a few minutes and answer additional questions if you like, but right now I'd just like to have everybody thank her, and those people that need to leave can do so. So thank you so much.